Hey everyone, welcome back to the channel. Today we're looking into the world of inflation, what it is, why it happens, and how to manage it. So let's begin from the basics. So, what is inflation? You could buy a Milma milk packet for 12 rupees and 50 paise in 2010 and now it costs 25 rupees. So you can see the differences, right? That's inflation in action. Inflation is the rate at which the general level of prices for goods and services rises, causing purchasing power to fall. Inflation can be caused by several factors. Let's look at the three main ones. The first one is demand pull inflation. This happens when the demand for goods and services exceeds the supply. Think of it as too many buyers chasing few products. It can drive prices up. The second is cost push inflation. When production costs rise, like when wages or raw material prices go up, businesses may pass these costs on to consumers in the form of higher prices. The third one is built-in inflation. This is a bit of a cycle. It occurs when workers demand higher wages to keep up with rising living costs, and businesses increase prices to cover higher wages, which then causes further inflation. Inflation is primarily influenced by several monetary factors. Let's discuss these in the upcoming video. There are a few ways inflation is measured. The most common is the Consumer Price Index or CPI, which tracks the prices of a basket of consumer goods and services. There's also the Producer Price Index or PPI, which focuses on the prices received by producers. And then there's the GDP deflator, which looks at the overall price level of all the goods and services in an economy. Now let's look into the effects of inflation. Inflation affects us all. It decreases our purchasing power, meaning we can buy less with the same amount of money. It also creates uncertainty, making it harder to plan for the future. And central banks might raise interest rates to try and control it, which can slow down economic growth. Now, how to manage inflation? Don't worry, there are ways to manage inflation. First, cost management is key. You can monitor operational costs closely, negotiate better deals with suppliers, and find ways to reduce waste. Then there are pricing strategies. Dynamic pricing allows businesses to adjust prices based on inflation, while value-based pricing focuses on the value delivered to customers. Financial planning is also crucial. Regularly updating budgets and considering inflation-protected investments can help keep things on track. And don't forget about operational efficiency. Streamlining processes, investing in energy efficiency, and adopting new technologies can all help costs down. Risk management is another important area. You can use hedging strategies, which is an advanced risk management strategy that involves buying or selling an investment to potentially help reduce the risk of loss of an existing position to protect against inflation risks or diversify investments to spread out risk. Managing employee wages is also key. Adjusting wages to keep up with inflation helps maintain morale and productivity. Understanding your customers through market research and communicating transparently about price changes can make a big difference too. And finally, engaging with policymakers and staying informed about economic trends can help you influence the policies that impact inflation. By using these strategies, you can control inflation effectively. Inflation is a normal part of a growing economy, but with the right tools, it doesn't have to be something to fear. If this video is informative and you found it helpful, do not forget to like, share, and subscribe to our channel. Thank you so much for watching, and I hope you have a great day.